Digital asset platforms don't operate in a vacuum. Every token, wallet, transfer, and settlement flow has to satisfy regulators across jurisdictions. In this module, we'll focus on the core architecture question. What must the platform prove, prevent, report, and control? So far, we've built the issuance foundation: market context, architecture, platform models, token design, settlement, and custody. Now we add the regulatory lens. Can those choices operate lawfully, securely, and defensibly before we move into deeper KYC, AML, and threat work? Think of regulation as a translation problem. Regulators begin with risk domains: protecting investors, keeping markets fair, preventing financial crime, preserving stability, protecting data, and ensuring systems keep working. Those risks become obligations tied to what the platform actually does: issue, custody, exchange, transfer, advise, or settle. Architecture then turns the obligations into capabilities: classification, permissions, monitoring, reporting, audit trails, records, and jurisdiction-aware rules. Legal analysis tells you what applies. System design determines whether it can operate at scale. MiCA is the EU's attempt to replace fragmented national crypto rules with one operating model. The key mental model is simple: classification first, obligation second. A crypto asset, an asset reference token, and an e-money token can trigger very different duties. Service providers also need authorization and controls for custody, disclosures, complaints, and resilience. But MiCA is not the whole map. If a token behaves like a financial instrument, traditional securities regimes such as MiFID II may still apply. Stablecoins receive special attention under MiCA because they can function like money. Regulators ask what value the token references. An e-money token tracks one official currency, so its architecture looks more like digital cash with strong redemption and reserve expectations. An asset reference token tracks a basket, often currencies, commodities, or crypto assets, which adds valuation and reserve complexity. If either becomes significant, supervision increases, including possible European Banking Authority involvement. Classification drives issuance, settlement, and compliance design. For a CASP, MiCA compliance is not just a license application. It becomes an operating model. That means governance, fit and proper leadership, prudential safeguards, and clear policies. It also means controls for customer assets, complaints, outsourcing, conflicts, and business continuity. Custody and transfers are especially sensitive. Private keys, segregation, reconciliation, and client instructions must be tightly controlled. The practical test is whether your systems can produce audit trails, access records, incident history, and regulator-ready evidence. MiCA also sits within a wider EU supervisory environment. ESMA shapes technical standards, market integrity, and CASP expectations, while the EBA focuses on stablecoins, reserves, prudential strength, and financial stability. GDPR then affects data architecture. Transparency is useful, but raw identity data does not belong on-chain. Keep personal data off-chain, store hashes or encrypted references, and maintain controlled evidence for audits, KYC, sanctions checks, and customer rights requests. The US model is less a single rulebook and more a jurisdictional puzzle. The same digital asset activity can trigger securities rules, commodities oversight, derivatives regulation, money transmission laws, sanctions screening, banking expectations, or state licensing. For tokenized securities, design choices matter. Who can hold the asset, where it can trade, how transfers are restricted, and what records are kept. In practice, US projects often build conservatively because compliance depends on the activity, the participants, and the context. US compliance is not only a securities question. A platform may also be a money services business under FinCEN, requiring AML controls, customer due diligence, suspicious activity reporting, and records. OFAC adds sanctions screening across users, wallets, counterparties, jurisdictions, and transactions. State money transmitter rules can also require licenses based on fiat, stablecoin, custody, exchange, or transfer activity. The operating model should connect onboarding, screening, monitoring, holds, escalation, and reporting. In the UK, crypto compliance is a set of controls that must work together. FCA registration focuses on governance, financial crime controls, and operational capability. Financial promotions rules shape every customer-facing message, including approvals, warnings, and risk acknowledgements. Custody adds expectations around safeguarding and resilience. Stablecoins are the moving edge, especially when used for payments. So UK platforms need configurable product access, onboarding gates, promotion workflows, and room for the regulatory perimeter to expand. The UAE is not a single regulatory answer. Dubai's VARA is purpose-built for virtual asset activities, such as exchange, custody, broker-dealer, lending, and advisory services. AdGem offers a mature financial services framework through the FSRA, often attractive for institutional custody and exchange models. DIFC operates under the DFSA, with rules tied to recognized crypto tokens. Market entry depends on entity choice, activity scope, custody, outsourcing, marketing, and cross-border client reach. Singapore is a useful model because regulation and innovation are designed to work together. Under the Payment Services Act, token exchange, transfer, custody, and facilitation activities sit inside a licensing and controls framework. MAS then adds expectations for AML, technology risk, safeguarding, governance, and reporting. For stablecoins, the focus is reserve quality, redemption, disclosure, and issuer prudence. A tokenized fund platform needs compliance embedded into issuance, custody, settlement, and cross-border flows from day one. Global standards may not be law by themselves, but they strongly shape regulatory expectations. FATF drives AML and counter-terrorist financing controls, including due diligence, sanctions screening, suspicious activity reporting, and the travel rule. IOSCO emphasizes market integrity, investor protection, custody, disclosures, and conflict controls. Basel influences how banks measure capital and prudential risk for crypto exposures. For architects, the takeaway is reusable control patterns for onboarding, monitoring, custody, reporting, and governance across jurisdictions. Cross-border compliance should not require a new platform for every market. The better pattern is a global core with local rule packs that configure who can onboard, which assets qualify, where transfers can move, and how settlement is allowed. Each decision needs evidence: KYC, consent, disclosures, wallet ownership, sanction screening, monitoring, custody, and reporting. Architecture decision records preserve the rationale, so expansion becomes controlled, auditable, and repeatable. Regulation gives us the map: which activities, jurisdictions, and global standards create obligations. Compliance architecture turns that map into platform controls: identity, KYC, AML, sanctions screening, transfer rules, and audit evidence. Next, we start designing that engine so regulatory expectations become enforceable, testable system behavior.